There's a pattern that separates legendary investors from everyone else. Not stock picking, not market timing, not luck, cash positioning. And when the greatest investor of all time builds the largest cash pile in corporate history, it's not an accident. Warren Buffett's Berkshire Hathaway is sitting on $325 billion in cash and short-term treasury bills. That's more cash than the GDP of most countries, more than Apple's annual revenue, more than the market cap of Tesla. And every financial pundit, every analyst, every expert is asking the same question: why? They think Buffett has lost his touch, that he's too old, too conservative, too out of step with modern markets. They're wrong, dead wrong, because this isn't senility, this isn't fear, this is preparation. 3 times in Buffett's career, he's built massive cash positions right before historic market crashes: 1987, 2000, 2008. Each time the experts criticized him, each time they called him outdated, and each time he used that cash to buy world-class companies at fire sale prices while everyone else was selling in panic. The pattern says it's happening again, and the size of this cash pile says what's coming will be bigger than anything we've seen before. Warren Buffett's Berkshire Hathaway is sitting on $325 billion in cash and short-term treasury bills. Let that number sink in. $325 billion. That's not a typo. That's not an estimate. That's more liquid cash than most countries produce in an entire year. To put this in perspective, Buffett's cash pile is larger than the GDP of Finland. It's bigger than Apple's annual revenue. It's more than the entire market capitalization of Tesla, Netflix, and McDonald's combined. This isn't just a lot of money. This is a financial fortress, unlike anything ever built in corporate history. And here's what makes it even more shocking. Berkshire Hathaway is not a bank. It's not a government. It's not designed to hoard cash. For 60 years, Warren Buffett has been the world's most aggressive buyer of stocks and companies. He's famous for saying his favorite holding period is forever. He's built his entire reputation on finding great businesses and never selling them. So why is the man who preaches time in the market beats timing the market suddenly sitting on enough cash to buy entire industries? Why is the investor who calls cash trash now holding the largest cash position in corporate history? Why is someone who's made $50 billion by staying fully invested suddenly keeping 25% of his empire in treasury bills, earning 4%? Wall Street analysts are baffled. Financial media calls it a mistake. They say Buffett has lost his edge, that he's become too conservative in his old age, that he doesn't understand modern markets. Some even suggest Berkshire shareholders should demand he step down because he's missing opportunities while markets reach new highs. They're missing the point completely. This isn't fear. This isn't confusion. This isn't the cautious behavior of a 94-year-old man who's lost his nerve. This is preparation. Cold, calculated, strategic preparation for what's coming next. Because Warren Buffett has done this before. 3 times in his career, he's built massive cash positions right before historic market crashes. Each time the experts criticized him. Each time they said he was wrong. And each time he used that cash to generate returns that made him a legend while everyone else was wiped out. The pattern is unmistakable, and the size of this cash fortress tells you everything you need to know about what Buffett sees ahead. But this cash fortress didn't appear overnight. Warren Buffett has built massive cash positions 3 times before in his career, not randomly, not by accident, always right before historic market crashes. And every single time, the financial world told him he was wrong. October 1987. Buffett had been building cash for months while markets soared to record highs. Financial analysts called him outdated. Wall Street laughed at his conservative approach. Then Black Monday hit. The Dow Jones crashed 22% in a single day, the worst one-day decline in stock market history. While everyone else was selling in panic, Buffett was buying with both hands. March 2000. The dot-com bubble was at its peak. Technology stocks were trading at insane valuations. Internet companies with no profits were worth billions. And Warren Buffett was sitting on $15 billion in cash, refusing to buy any of it. The media destroyed him. They said he didn't understand the new economy, that he was a relic from an older era, that the rules had changed forever. Then the bubble burst. The Nasdaq crashed 78% over the next 2 years. Trillions of dollars evaporated. Legendary companies disappeared overnight. But Buffett, he started buying. Coca-Cola at discounted prices, Washington Post at fire sale valuations. While everyone else was broke and panicking, he was deploying his cash hoard. September 2008, the biggest cash position yet. Berkshire was holding $44 billion in cash and treasury bills right before Lehman Brothers collapsed. Once again, critics said he was too conservative, too scared, missing the boom in financial stocks and real estate. The economy looked unstoppable. Housing prices only went up. Banks were printing money. Then everything collapsed. The financial system nearly died. Banks that had been profitable for decades went bankrupt in weeks. But Buffett became America's financial savior. He used his cash to make legendary deals. $5 billion to Goldman Sachs, $5 billion to Bank of America. Deals that generated billions in profits while the rest of the world burned 3 times. 3 massive cash builds, 3 historic crashes, 3 incredible buying opportunities that only happened because he had cash ready when everyone else needed to sell. This isn't luck. This isn't coincidence. This is pattern recognition at its finest. And now he's doing it again. But this time, the cash position is bigger than all 3 previous builds combined, which means what's coming next will dwarf everything that came before. The 1987 crash wasn't just Buffett's first major test. It was the blueprint for everything that followed, and it started with Wall Street calling him a fool. Throughout 1986 and early 87, markets were roaring. The Dow had tripled in 5 years. Everyone was getting rich. Stock tips were shared at cocktail parties. Taxi drivers were giving investment advice. Classic bubble behavior. But while everyone else was buying, Buffett was selling. He liquidated positions in companies he'd held for years. He stopped making new investments. By October 1987, Berkshire Hathaway was sitting on more cash than it had ever held in its history. Financial magazines wrote articles questioning his judgment. Analysts wondered if the Oracle of Omaha had lost his touch. Then came October 19th, Black Monday. The Dow Jones plummeted 508 points, 22.6% in a single day, more than twice the percentage decline of the 1929 crash that started the Great Depression. Panic selling overwhelmed the markets. Computer trading programs made everything worse. Fortunes built over decades vanished in hours. But Buffett wasn't panicking. He was shopping. While everyone else was liquidating everything they owned, he was making phone calls. Coca-Cola, a company he'd watched for years but considered overpriced, suddenly became attractive. The Washington Post company, which he already owned but wanted more of, was trading at a massive discount. He deployed his cash systematically. Not all at once, because he understood crashes take time to play out, but steadily, methodically, buying world-class businesses at prices he'd only dreamed of months earlier. Companies with strong brands, loyal customers, and proven management were suddenly available at bargain prices. The results were spectacular. His Coca-Cola investment, purchased during the crash aftermath, would eventually become worth over $20 billion, a 40-fold return. His additional Washington Post purchases generated similar outsized gains. While most investors took years to recover their losses, Buffett's wealth exploded. But here's the key insight. The cash position wasn't just about having money to buy during the crash. It was about having the psychological strength to act when everyone else was paralyzed by fear. When your neighbors are losing their homes and your friends are losing their jobs, it takes incredible discipline to buy stocks. But cash gives you that power. 1987 taught Buffett the most valuable lesson in investing. The best opportunities come when everyone else is forced to sell. But you can only take advantage if you're prepared with cash. But 1987 was just the beginning. The dot-com bubble would prove the pattern on a scale that made Black Monday look like a minor correction. And once again, Warren Buffett would be labeled a dinosaur right before he was proven spectacularly right. By 1999, the internet had changed everything, or so everyone believed. Companies with no profits were worth billions. Pets.com was valued higher than established retailers. Amazon traded at 300 times earnings. Yahoo was worth more than General Motors and Ford combined. The rules of investing, they said, no longer applied. Warren Buffett watched from the sidelines with growing alarm. At Berkshire's annual meeting, shareholders demanded to know why he wasn't buying technology stocks. Financial journalists wrote scathing articles about his outdated approach. One magazine ran a cover story asking if Buffett had lost his edge. The Oracle of Omaha, they said, didn't understand the new economy. His response was classic Buffett. He didn't understand technology well enough to value it properly. He wouldn't buy what he couldn't understand. While dot-com companies burned through millions with no path to profitability, he sat on $15 billion in cash, the largest cash position in Berkshire's history at that time. The ridicule was relentless. At the 2000 annual meeting, one shareholder stood up and accused Buffett of being too old and too conservative. Young fund managers who'd never lived through a real bear market called him a relic. His own shareholders questioned whether he should step down. Then the music stopped. In March 2000, the Nasdaq reached its peak and began to collapse. What followed was carnage beyond imagination. The index fell 78% over the next 2 years. Companies that were worth billions became worthless overnight. Pets.com, the poster child of internet excess, liquidated completely. Amazon dropped from $106 to $6 per share. But while fortunes evaporated and retirement accounts disappeared, Buffett went shopping. He bought more Coca-Cola. He increased his stake in American Express. He purchased additional shares of his favorite insurance companies, all at prices he hadn't seen in years. The returns were extraordinary. His cash deployment during the dot-com crash generated some of the best returns in Berkshire's history. Companies he bought at distressed prices doubled, tripled, and quadrupled as markets recovered. Meanwhile, investors who'd mocked his conservative approach spent years trying to recover their losses. The pattern was now undeniable. Build cash during bubbles. bubbles. Deploy during crashes, profit enormously, while others suffer. The dot-com crash proved the pattern worked, but 2008 would elevate Warren Buffett from legendary investor to financial savior of America. And it all started with the biggest cash position he'd ever built. By 2007, Buffett was sitting on $44 billion in cash and treasury bills, the largest war chest in corporate history at that time. Real estate was booming. Banks were making fortunes on subprime mortgages. Financial stocks were hitting record highs. Bear Stearns, Lehman Brothers, and Goldman Sachs were printing money. Once again, the critics emerged. Why wasn't Buffett buying bank stocks? Why was he missing the real estate boom? Housing prices only went up, they said. This time was different. The economy had evolved beyond old-fashioned boom and bust cycles. Modern financial engineering had eliminated risk. Buffett knew better. He'd been studying the mortgage market and didn't like what he saw. Loans to people with no income, no documentation required, adjustable rates that would explode higher. The entire system was built on a foundation of sand, so he waited with his cash pile growing larger. September 2008, Lehman Brothers collapsed overnight. The financial system seized up completely. Banks that had dominated Wall Street for over a century disappeared in weeks. Bear Stearns was sold for $2 per share. Merrill Lynch was forced into an emergency merger. AIG, one of the world's largest insurers, needed a government bailout to survive. While panic consumed Wall Street, Buffett's phone started ringing. Goldman Sachs, the most prestigious investment bank on earth, was desperate for capital. They offered Buffett terms no ordinary investor could ever get. $5 billion for preferred shares paying 10% annual dividends, plus warrants to buy more stock at bargain prices. Bank of America came next, another $5 billion deal with similar extraordinary terms. Then General Electric. One company after another, begging Warren Buffett to save them with his cash hoard. He became America's financial white knight, providing liquidity when the entire system was freezing up. The profits were astronomical. His Goldman Sachs investment generated over $3 billion in gains. Bank of America made him even more. While banks across America were failing and millions of people were losing their homes, Buffett was making the most profitable trades of his career. But here's what made 2008 different. This wasn't just about stock picking. Buffett's cash position made him systemically important. The government needed him to stabilize markets. He had become too powerful to ignore. And now his cash position is 7 times larger than it was in 2008, which brings us to today. And every single warning sign that preceded the 1987 crash, the dot-com bubble, and the 2008 financial crisis is flashing red again. But this time, they're all happening simultaneously. Start with valuations. The S&P 500 is trading at 28 times earnings. That's higher than it was before the dot-com crash, higher than before 2008, only exceeded once in history, right before the 1929 crash that started the Great Depression. Traditional metrics say stocks are more overvalued than they've been in nearly a century, but it gets worse. The everything bubble isn't just stocks anymore. Real estate prices have exploded past 2006 levels. Commercial property is trading at prices that assume interest rates will stay near zero forever. Cryptocurrency markets have created trillions in value from nothing. Even collectibles like art, wine, and trading cards are hitting record prices. Meanwhile, debt levels have reached unprecedented heights. Total U.S. debt is $36 trillion and climbing. Corporate debt has doubled since 2008. Consumer debt is at all-time highs despite supposedly strong economic conditions. The entire system is leveraged beyond anything we've seen before. And just like previous bubbles, everyone believes this time is different. Artificial intelligence will revolutionize everything, they say. The Federal Reserve has solved boom and bust cycles. Modern monetary theory means deficits don't matter. Stock prices can only go up because there's nowhere else to put money. Warren Buffett sees through the nonsense. He's been steadily selling his largest holdings. Apple, his biggest position for years, has been cut by more than half. He's avoiding technology stocks completely. He's refused to buy anything at current prices despite having more cash than ever to deploy. His actions speak louder than any analyst report. When the world's greatest investor stops buying stocks and starts hoarding cash, that's not a random decision. That's preparation for what's coming next. The signs are everywhere if you know how to look. Market sentiment is at extreme euphoria levels. Retail investors are borrowing money to buy stocks. Day trading has become a social media phenomenon. Everyone from college students to retirees thinks they're investment geniuses because everything goes up. But Warren Buffett has lived through this movie before, 3 times. He knows how it ends. The question isn't if the bubble will burst. The question is when. And his $325 billion cash position suggests the answer is soon. But Warren Buffett isn't just building cash because markets are overvalued. He's building the largest cash position in corporate history because what's coming will be unlike anything we've seen before. And his recent moves reveal exactly what he's preparing for. Look at his Apple sales. Buffett called Apple the best business in the world. He said he'd never sell a share share. It became Berkshire's largest holding, worth over $100 billion at its peak. Then he started selling, not a little, not trimming around the edges. He sold more than half his position, turning his biggest winner into cash. This isn't portfolio rebalancing. This isn't taking profits. This is preparation for a crash so severe that even the world's best companies will become buying opportunities. When Warren Buffett sells Apple, he's telling you that nothing is safe at current prices. His other moves are equally telling. He's avoided artificial intelligence stocks completely while they've soared to insane valuations. He's stayed away from electric vehicle companies despite massive hype. He's refused to buy cryptocurrency or any blockchain investments. Everything the market is euphoric about, Buffett is avoiding. Instead, he's buying treasury bills, short-term government bonds that earn 4% annually. The financial media calls this a waste. Why earn 4% when stocks are making 20%? Because Buffett knows those stock gains are an illusion built on borrowed money and inflated valuations. The scale of his cash build tells you everything about the magnitude of what's coming. In 1987, his cash position was large for Berkshire, but small in absolute terms. In 2000, it was $15 billion. In 2008, it was $44 billion. Today, it's $325 billion, 7 times larger than before the financial crisis. That suggests the coming crash will be 7 times worse than 2008, 7 times more destructive, 7 times more opportunity for those prepared with cash. The math is terrifying and exciting simultaneously. And there's something else. Warren Buffett is 94 years old. This will almost certainly be his final major market cycle, his last chance to deploy massive capital during a historic crash. The man who's spent 70 years perfecting the art of crisis investing is making his biggest bet ever. He's not building this cash fortress for his heirs. He's not being conservative because of his age. He's preparing for the opportunity of multiple lifetimes, the chance to buy world-class businesses at once-in-a-generation prices while everyone else is forced to sell. The cash position reveals the timeline. The crash is coming soon, and it will be massive. The coming crash will create the buying opportunity of multiple lifetimes. And Warren Buffett's $325 billion cash position reveals he knows exactly when it's arriving and how devastating it will be. Think about what happened during previous crashes. In 1987, Coca-Cola became a bargain that generated 40 times returns. During the dot-com collapse, solid companies traded at fire sale prices, while worthless internet stocks went to zero. In 2008, Goldman Sachs and Bank of America practically begged Buffett to save them with terms no normal investor could ever get. But this time will be different. Not in the way bubbles always claim to be different. Different because the scale is unprecedented. The debt levels are higher. The valuations are more extreme. The leverage is more dangerous. When this bubble bursts, the opportunities will be proportionally massive. Apple, the world's most valuable company, could drop 70% like it did during the dot-com crash. Microsoft, Google, Amazon, all the technology giants that seem invincible today will trade at fractions of current prices. Real estate empires built on cheap money will collapse. Cryptocurrency fortunes will evaporate overnight. And Warren Buffett will be there with more cash than any investor in history. He'll buy the best companies on earth at prices not seen in decades. While pension funds are forced to liquidate, while retail investors panic sell, while hedge funds face massive redemptions, Buffett will be deploying capital systematically and ruthlessly. This explains why his cash position dwarfs previous builds. The opportunities will be proportionally larger. Companies worth trillions today will be available for hundreds of billions. Entire industries will trade at distressed valuations. The wealth transfer will be astronomical. But there's a deeper factor. Warren Buffett is 94 years old. This is almost certainly his final major market cycle, his last chance to apply 7 decades of investing wisdom during a historic crash. The man who's made $50 billion by buying during panics is preparing for his masterpiece. History shows us that massive wealth is created during crashes, not bull markets. The Rockefellers, the Rothschilds, the Kennedys all built their fortunes by having capital ready when everyone else was broke. Buffett has done it 3 times already, but this 4th time, with the largest cash position ever assembled, will dwarf everything that came before. The pattern never lies. The cash position reveals the truth, and $325 billion doesn't lie dormant by accident. Warren Buffett sees what's coming. The only question is whether you're prepared for what happens next.